This video reviews East Japan Railway's financial results for the second quarter of fiscal year 2026, covering the period from April to September 2025. JR East, or East Japan Railway Company, is one of Japan's major railway operators. JR East mainly serves eastern Japan, including Tokyo and the northern and eastern parts of Honshu, operating Shinkansen, commuter trains, hotels, and shopping malls. Highlights on financial results. Operating income in the first half of the fiscal year significantly exceeded the plan, mainly due to strong use of railways and other contributing factors. Based on these strong results and the improved outlook, JR East revised its full-year earnings forecast. In line with this, the full-year dividend forecast for FY2026 was raised from 62 yen to 70 yen, including an interim dividend of 35 yen. This reflects the company's shareholder return policy, which aims to gradually increase the dividend payout ratio to 40% by FY2028 as growth investments stabilize. Upward operating revenue forecast is 3,058 billion yen, an increase of 35 billion yen from the previous forecast, and revised net profit is 237 billion yen, up 10 billion yen. All figures for operating revenue, operating income, net profit, EBITDA, and ROE show increases compared with the previous forecast. JR East reported that both revenue and profit increased in the second quarter. Operating revenues rose for the fifth consecutive year, mainly because of higher railway usage and stronger sales at Takanawa stores inside stations. Although operating income decreased slightly due to a drop in profits from real estate sales, profit grew thanks to higher gains from the sale of investment securities. All business segments recorded higher revenues. Transportation benefited from increased passenger demand. Retail and services grew due to robust in-station sales. Real estate and hotels more from office leasing and shopping centers, but saw lower income due to fewer real estate sales, and other businesses increased profits through system development sales. JR East revised its full-year forecast upward and raised its interim dividend to 35 yen per share, with the year-end dividend forecast also increased to 35 yen, reflecting its shareholder return policy under to the next stage 2034. In transportation segment, revenue from the Shinkansen increased year-on-year as more passengers used the service. Revenue from conventional lines also rose, supported by higher usage of commuter and non-commuter passes in the Kanto area and by the introduction of green cars on the Chuo Line Rapid. Overall, operating revenues in the transportation segment reached 998.9 billion yen, up 4.9% from the previous year, while operating income increased slightly. JR East's plan and results for commuter and non-commuter passes, as well as Shinkansen use, all showed stable growth, indicating continued recovery and solid travel demand. JR East plans to revise railway fares and charges starting March 2026, which is expected to increase annual revenue by 82 billion yen. Because price revisions require government approval, JR East will continue working with other companies to submit requests to the national authority in order to implement a more flexible railway fare and charge system. In retail and services segment, revenue increased compared with the previous year, mainly because sales at Takanawa stores rose as railway usage continued to recover. Advertising and publishing revenue also grew thanks to stronger demand for transportation-related advertising. JR East's overseas business contributed more as Decorum Vending Limited, a vending machine operator in the United Kingdom, was consolidated for the full fiscal year, boosting overall results. As a result, operating revenue reached 201 billion yen, up 5.8% year-on-year, and operating income increased, a rise of 12.5%. The data indicate that the recovery in passenger movement and stronger in-station sales led to higher performance across JR East's retail and service operations. In real estate and hotels segment, revenue from real estate ownership and utilization increased because of higher office leasing income following the opening of Takanawa Gateway City, as well as stronger sales at shopping centers and hotels. However, revenue from the real estate rotation business declined due to fewer property sales, while real estate management revenue rose thanks to a greater number of properties under management. As a result, total operating revenue for the segment grew to 215.6 billion yen, an increase of 4% from the previous year. but operating income fell due to the decline in real estate sales. The hotel business performed well, with higher occupancy rates and strong room sales at both Hotel Metropolitan and JR East Hotel Metz, leading to increased operating income. Overall, the segment achieved higher revenue but lower profit, mainly because of reduced real estate sale gains, despite steady growth in leasing and hotel operations. JR East is pursuing co-creation urban development in the greater Shinagawa area, which spans from Hamamatsucho Station to Oimachi Station, to enhance the appeal and value of Tokyo as an international city. Rather than developing each station area individually, the strategy looks at the entire area as a whole. JR East plans to grow its real estate business and exceed 100 billion yen in annual revenue by the mid-2030s. JR East Group is promoting a unique real estate rotation strategy that uses its strong pipeline of development sites to create new projects. The company plans to steadily sell and replace assets, targeting asset liquidation of around 1 trillion yen and operating income of about 600 billion yen from real estate sales by FY2032. It also aims to expand its real estate fund business, managing assets worth 1 trillion yen by FY2032. Real estate prices in Tokyo continue to hit record highs every year. Although the real estate business saw a decline in profit this time, JR East owns properties in prime locations in Tokyo, and the real estate business is expected to continue expanding in the future. Stock price. This chart over the past year shows the stock price in Japanese yen at 3,596 yen as of October 30. This chart shows the stock price in US dollars at 11.77 as of October 30. In recent years, the stock price has been steadily rising, and it has continued to increase after this earnings announcement. Current PBR is 1.36, and PR is 17.1. Dividend yield is 1.95%. Compared with the past few years, the stock looks slightly expensive in terms of PBR, but the stock is relatively cheap in terms of PER and dividend yield, since earnings per share and dividend amounts have been increasing more than the stock price rises. Since the company has been steadily increasing its earnings and dividends after the COVID pandemic, the current stock price seems reasonable to buy. Conclusion. JR East first half of FY 2026 was overall good, driven by steady recovery in railway demand and solid growth across retail, service, and hotels. Despite lower gains from real estate sales, overall revenue and profit both increased, leading the company to raise its full-year forecast and dividend. Stable earnings from the railway business and future growth potential in Tokyo real estate remain promising.